Alright guys, so the trade war is still in a dangerous limbo. We are still waiting for someone to pick up the phone and call first. The US is also scrambling to sign their 90 deals in 90 days, and that almost guarantees the agreements will be botched and won't really change a thing. The Secretary of Trade is also busy working to make US fish great again.
With your leadership and your trading policies, we're going to open all of these markets and we're going to let our fishermen thrive and prosper. And we are going to have lower cost fish, more of it, and the freshest fish in the world. And this is just common sense for the United States of America.
Meanwhile, China just concluded a trip to Asia and they are now strengthening their trading network. So there's a lot of work going on behind the scenes. But let's leave the trade side of things for a bit and talk about the financial decoupling, the financial war. This is just as important as the trade tariffs because the US and Chinese financial markets are about to get torn apart. And we are talking about a big iron curtain going between them and both sides day one out. A congressional committee is telling two of the biggest US banks not to work with China. JP Morgan and Bank of America are supposed to help CATL, the EV battery maker, with their IPO. But here's the crazy part. This IPO isn't even in New York, it's in a Hong Kong exchange. Why? Because the banks are exposing themselves and US investors to regulation, financial, and reputational risks. The justification was that CATL is on a Pentagon blacklist and somehow connected to the Chinese military. However, once again, this is an overreach. Not only is US trade now in jeopardy, American banking services are now under threat from within. It's so bizarre that the committee even wrote a letter to Jamie Dimon to tell him to get the bank to back down. And in the same letter, they highlighted what is coming down the road. The United States will establish new rules to stop US companies and investors from investing in industries that advance the PRC's national military civil fusion strategy. As we reported on this a few weeks ago, the US is looking to stop the flow of money and investments into China, and Beijing is also doing the same to stop financial flows into US companies. This also poses a problem. Many US banks operate within mainland China and Hong Kong, and they do everything from asset management to investment banking to trade financing. And if this goes through, Congress might expand their net and collapse even more banking deals down the road. It's a shame because CATL listing is slated to be amongst the world's biggest in 2025 to investors. The offer size is around $5 billion, and that means big fees for the American banks underwriting the offer. If the reason is to choke away capital to CATL, I think Congress has sorely miscalculated their hand. The company isn't collapsing and they have a ton of cash to work with. JP Morgan and Bank of America aren't the only boys in town as well. Other international banks like HSBC can definitely come in and fill the gap. Underwriting an IPO isn't some complex endeavor like launching a rocket into space. Competition is fierce, and there are many other international banks that can get the deal done. But it does tell us how desperate the US is to punish Chinese companies, especially those in technology and cutting edge industries. For decades, the US and China, their financial markets, they have been very interconnected. US banks, they give Chinese investors and companies an outlet to connect with the greater US economy. US banks also needs China because of the huge market. But this economic war could see services being pulled away on the basis of national security. But there could be another time bomb that could detonate in the global financial markets, and that is the US forcing Chinese companies to delist from the United States from exchanges like in New York. According to Goldman, US investors could be forced to offload $800 billion of money in Chinese stocks. They call this the extreme financial decoupling scenario, but personally, I think it's likely to happen if we keep going down this dark road. There are four ways to buy Chinese equities today. The A-share market are shares listed in China directly, but mostly closed off to foreigners. So you either buy Chinese stocks listed in Hong Kong called H shares, or you buy those that are listed in the United States like Alibaba. Together with Hong Kong shares, US investors have piled over $800 billion into the Chinese markets. And if Trump forces investors to leave, we could see a big exodus of money leaving China shares, and that would crash prices down by around 4% in overall value. But this also means US investors can no longer participate in China's growth. But understand what this also means. Foreign investors who would normally buy Chinese shares through the US markets will be forced to leave and open an account directly in Hong Kong. And it makes sense. You can't buy Alibaba in New York anymore, so you have to head directly to the Chinese markets. And they will ditch the USD for Hong Kong dollars to buy the stocks. In other words, this makes Wall Street, the dollar, even less relevant in financial markets. And let's be real, Besant himself has not denied that Chinese stocks won't be delisted. That card is on the table and could be played if the US wants to ramp things up.
How far are you willing to take this in terms of this soft war with China? We've got Chinese stocks trading on U.S. exchanges. U.S. investors are buying those stocks, and that's helping China fund its military. Let's face it. Are you willing to go that far to remove Chinese stocks from U.S. exchanges?
Well, Maria, I think everything's on the table. We are putting in process export controls for high-value security-related goods. We are talking about the export capital controls in terms of, as you said, a blacklist of things that U.S. Whether pension funds, endowments, investors should not be investing in to fund the Chinese military machine.
But here's the problem. Chinese investors also have a ton of money in US markets. It cuts both ways. If Congress forces US money to leave Beijing, don't you think China will do the same? This won't be a walk in the park for Trump. We will see financial retaliation where US assets gets dumped by Chinese executive orders as well. There's an estimated $1.7 trillion worth of US assets in the hands of Chinese investors, and that's $370 billion in equities and $1.3 trillion in bonds. And we aren't even counting in the amount of treasuries the PBOC, China's central bank, owns. All this could be dumped in a hurry that will spook markets out even more. US stock prices could take a hit and bond yields could spike higher if China does a total dump. Realize that Chinese investors have other avenues to put their money in. For one, China is propping up their own domestic stock market, and normally they hate to do this, but the central government no longer has any choice but to intervene. Over the past few days, China's Wealth Fund was seen actively buying Chinese stocks to manage the prices. They didn't want to let the market close on the loss to bolster confidence, especially for local investors. Now, whether you like this or not, that's how China runs their economy and markets. Lots of state intervention. They have an unlimited amount of money to play with because of their trade surplus and their low borrowing costs. Bond yields are extremely low in China, which means in the case of a full US-China financial decoupling, Chinese stocks might not collapse. The state might put a floor under prices as investors pull money away from the US and relocate capital all the way to Hong Kong. And this should be very alarming for Washington and Wall Street. China is way behind the eight ball when it comes to financial services. US banks still lead by a mile. But what have we seen over the last decade? The more the US decouples with Beijing, the more they will force Chinese industries to run faster. It might sound unthinkable today, but China will innovate harder and improve their banking sector. For many people, they believe US banks are the biggest in the world, and that is true when you measure their value by market cap in the stock market. Banks like JP Morgan sit on top, but it's a whole other story when you measure them by their assets. Chinese banks are in pole position. The top four banks are all Chinese, and first place goes to the Industrial and Commercial Bank of China, or ICBC. They hold over $5.7 trillion in 2023, and last year it was over 6 trillion easily. So these aren't small entities. If they decide to push for more global reach, more innovative products, they can easily exceed US banks, especially in the BRICS countries and emerging markets. But we don't need to wait for the decoupling to happen. Global banking giant Deutsche Bank is already seeing a big trend happening. Chinese investors are moving their money out of US assets. They are just like any other investor. Chinese investors are practical and they chase future returns, but recent performance in US assets have left them afraid and spooked. US bonds used to be a favorite haven for Chinese money, but over the last week, we have seen yields fly up, which means bond values have also crashed. In the same breath, the value of US dollars also fell. So it's a double whammy for Chinese investors. Not only do they lose nominal value if they sell now, when they convert back to the RMB, they could lose even more. As a result, Chinese money is flowing elsewhere. It's moving into EU bonds, gold, and even Japanese government debt. Treasury bonds are no longer the risk free asset anymore. And because of this, US stocks and bonds will be under big pressure. The bear market could last for quite a while longer until Trump manages to bring back confidence into the US markets. And there's a foreboding sense of dread within the US that goes beyond just China deleveraging their holdings. Bank of America is witnessing huge outflows of capital from foreigners. Investors withdrew over $6 billion from US equity funds last week, the second largest amount on record. Only the panic during the SVB crisis exceeded that amount, and foreigners they hold a lot of money in US assets. They hold around $18.5 trillion worth of stocks, or 20% of the total US equity market. They also hold 7.2 trillion worth of treasury bonds. That's 30% of the entire outstanding market as well. On a fundamental level, investors they want to see two things return to the US economy before they are confident in coming back is really simple. Firstly, there has to be some sanity in US trade policy, doesn't it? Will the tariffs be 10% across the board for the next 4 years? Or is everything still up in the air? Without clarity, the market can't price in company earnings and the risks associated with that. Unless, of course, you pay very close attention to Trump's tweets and buy when he tells you to buy. I mean, the entire US stock market is becoming one big casino. But what we really need is for the US and China to at least have a dialogue, at least a phone call to get the ball rolling. But we still have nothing except Trump teasing the media, telling us maybe he called, maybe he didn't call.
We're talking.
Have you spoken to him directly, to President Xi?
I don't want to say that. Yeah. It's just not appropriate.
But you're speaking. Sorry. Has he called you directly, President Xi, or reached out to try to facilitate a conversation?
Well, you'd think it was pretty obvious that he has, but we will talk about that soon. It's not that important because honestly, we're going to have a deal. I believe we're going to have a deal with China. And if we don't, we're going to have a deal anyway because we're going to set a certain target and that's going to be it.
Now, I still can't make heads or tails if China called or not. The White House is in a state of absolute disarray. And until something gets worked out with Beijing, we'll see even more money leave US assets. And let's be crystal clear, where the money is flowing to, the big winner once again will be gold. Chinese investors alone have poured nearly $800 million into a local gold ETFs in Shanghai. We aren't even counting in physical gold demand and people buying Western ETFs like GLD. In March, collective holdings rose by additional 7.7 tons to nearly 140, and we aren't even counting in numbers in April, which would likely be very explosive. Just wait another 30 days for the data to update. So there will be winners and losers in this decoupling, and I hate to say it, but this can't be stopped. Even if Trump stops his trade war tomorrow, it would just slow things down at the very most. But let me know what you think. Will China sell even more US assets? And will Congress force US banks to abandon their Chinese clients? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.